Can you guess what all successful property investors have in common? They know how to read the market. Australian Property Investor Magazine. Read the market at newsagents now.
Well, we've had a really extended downturn in residential building, stretching back to 2003, which is really unusual. We had rising interest rates over that whole period up until the middle of last year, and that was done so that we could enable a business investment upturn, a boom in mining and commercial building. But with the financial crisis, a lot of money's flowed out of those sectors, and we've needed to stimulate housing construction. We're certainly looking for an extended recovery. First home buyer numbers will start to fade over the next 3 to 6 months, but we're already seeing a pickup in upgraded demand for housing. The latest figures showing that running at 20% above where it was a year ago. So there's cause for optimism from the upgrader segment. And in terms of investors, there is some improvement there. It'll probably really strengthen towards the end of this year. I think some investors are waiting for the first home buyers numbers to drop away. But also I think there'll be a recognition that interest rates are going to be low for quite a while by historical standards. Well, we're seeing the pickup first in the areas that are most affordable. So first home buyers are going for detached houses, and the pickup's greatest in Melbourne, in Adelaide, in Canberra, in areas where land prices are relatively low. But even within Sydney and parts of southeast Queensland, we're seeing some pickups, but generally where land prices are relatively low. As we go forward, I think the higher values and the medium value properties are going to pick up quite well towards the end of this year. That's the kind of property that an upgrader would be looking at, and it's that segment of demand that's going to pick up more as the year progresses. I think up until a couple of months ago there were question marks on the sustainability of demand, that the first home buyer boost was really just a pull forward effect, and that once that ended that we'd be back in a world of fairly subdued demand. I think over the last 6 weeks there's been a recognition that the economy is actually performing quite well. The peak in unemployment is going to be lower than expected previously, and with rates still low, I think there's an increasing view that we are in for a sustained upturn in the building side. More so again on detached houses. Apartment construction is still being plagued by problems with obtaining finance from a developer's point of view. Well, we expect that interest rates are going to stay on hold for the next 6 months, and it's really those low interest rates in combination with further evidence of prices actually increasing. We've got a rise in June quarter of this year. We think we're in for further rises over the second half of this year, and that'll give confidence in the outlook in terms of prices. So even though there's an upside in rates, I think we've moved past the worst of it in terms of sentiment, and there'll also be evidence in terms of the tightness of the market, because while we're getting an upturn now in commencements, the actual supply of completed housing is going to be falling for the next 12 months. So it's going to be tightening rental markets, particularly in Sydney and in Brisbane. We expect a really strong pickup in renovation spending in the order of 7-10% across the country. That'll be the strongest growth that we've had in more than 5 years. And there's 2 reasons for that. One is we're seeing big increases in people taking out loans for renovations, which they certainly weren't doing when interest rates pushed up over 8-9%. So it's a very affordable time to be undertaking a renovation. Secondly, the turnover of older properties, particularly first home buyers buying some fairly old houses, those households will be looking at renovations, and that'll be true of some upgraders as well. So really the economics of renovation really stack up well at the moment. I think we're in for a pretty strong growth period. Well, the market's pricing in a rate rise in the cash rate before the end of this year. We think that's premature. We don't look for an increase in the cash rate until the middle of next year. Our view is that there's still a lot of water to come under the bridge in business investment. So we think that mining investment is set to now decline significantly. We know that commercial building will be weak. We know that apartment construction is going to be weak. So key parts of the construction sector are under pressure for the next 6 months, and we're going to lose that benefit from stimulus payments to households. So household spending is likely to moderate considerably from here. So really we've got some hard yards to be made over the next 12 months, and I think with that in mind, rate rises are 12 months away.